Good day, everyone. My name is Ted Gardner. I'm a Senior Portfolio Manager on Westwood's Energy Infrastructure Complex. Today, I'm just going to run through some of the developments that we saw in November and talk a little bit about the oil markets, as well as some of company guidance that we've seen come out over the last few weeks. So beginning with returns, it was a very solid month for the Energy Infrastructure Group, with all three of the indices being up around 7%. Oil was down 6%, which it's nice to see the correlation break down a bit between our space and the price of crude oil. However, the broader energy equities, such as the XLE, it was down a little bit, whereas the E&Ps and oil services companies were down more significantly for the month. Year to date, our space is leading the pack with the AMNA up 14.6%. Solid return, although it is well below the AMZ return of 29.4%. As we've mentioned in the past, that is a very concentrated index now that is MLP only, and we have seen some very strong performance out of some of those names, including the buyout of Magellan, which was a large weight of the index, and that's one of the drivers of those returns. Looking at the three buckets, C Corps were up 4.4% for the month on average, led by InLink, which was up over 11%. The MLP average was 6.6%, led by Newstar, which was up almost 14%. And then the Canadians were up 5.7% on average, led by a solid gain on Enbridge of 8.7%. When we look at the year-to-date averages, MLPs, as I mentioned a moment ago, have by far done the best among the three groups. Their average is around 26% for the year, and that's led by Plains, which is up almost 46% for the year. C Corps are up 9.3% on average, with Equitrans leading the charge, up 49.5% on the back of positive developments with their Mountain Valley Pipeline. And then the Canadian average has been only 5.7%. That's been led by AltaGas, which is up 22%. And if you take a look at the lowest column there for Canadians, Enbridge and TransCanada are both negative for the year, and that is one of the main factors that we've seen with the AMNA lagging the broader MLP group, because both Enbridge and TRP are very large positions in the AMNA index. As I showed you a minute ago, oil was down about 6% for the month, and that has actually taken it into negative territory for the year, which is somewhat surprising, as we were trading at $95 just at the end of September. So quite a sharp correction over the last 2 months, as we actually hit $68 here just a few days ago. And the reason, frankly, is that production growth has come in stronger than anybody really expected. Demand growth has been solid this year. We are at an all-time high of 102 million barrels per day of total liquids demand globally. That includes both crude oil and natural gas liquids. But non-OPEC production growth, despite the cuts that we've seen in OPEC plus, the non-OPEC production has grown about 1.8 million barrels per day, with the U.S. leading the charge of about 1.1 million barrels per day. And just out for context, most people expected U.S. production to only grow between 400,000 and 600,000 barrels a day this year. So we're well above that. And it's actually hit a new high for production here in the U.S. The good news about that is that our space, the energy infrastructure space, is really all about volume. So at this point, we have all-time high volumes of crude oil flowing through the infrastructure system here. Turning to guidance that we've seen out of a few companies over the last few weeks, we have seen a handful of companies release. Primarily, it's been Kinder Morgan in the U.S., as well as the larger Canadians, which we show here on the slide. In general, what we've seen is that EBITDA has been in line or slightly ahead of consensus, but CapEx has also been slightly higher than expected. Looking at Kinder Morgan, EBITDA guidance was $8 billion for 2024, which is just slightly ahead of consensus of $7.9 billion, but that does not include the impact of an acquisition that they announced a couple months ago that is not yet closed. CapEx actually came in above expectations at $2.3 billion. Kinder is guided to a long-term range of $1 to $2 billion of CapEx. So this is a number that is above expectation, but they were also quick to note that 70% of that spend will come in at about a 4.7 times average EBITDA multiple. So it is highly efficient CapEx. TC Energy, one of the large Canadians, they like to guide in percentages rather than dollars, but they guided to 2024 EBITDA growth of 5 to 7%, while consensus was at roughly 3%. CapEx again came in quite a bit higher at 1 to 1.5 billion. TC is another company that has put a stated long-term range out there. For them, it's about 6 billion. So they came in at $7 to $7.5 billion for 2024. Enbridge guided to 16.6 to 17.2 billion Canadian dollars versus consensus of 17 billion. So right in the range of what was expected for consensus. That again excludes the impact of an acquisition that they announced but not yet closed of the 3 gas utilities from Dominion here in the US. And they also guided a CapEx that was about $500 million Canadian higher than consensus. So generally what we see on guidance is most companies do their forward guidance along with their fourth quarter earnings. So we'll look forward to hearing more, particularly from the US companies as they report earnings in the late January to mid-February time frame. Thank you for joining us today. If you have any questions, please contact your Westwood representative. And we'll see you again in 2024.